मुसीबत है यार ऑर्डर बुक्स पूसा Okay, hello and welcome to today's. Now, in today's class, I'm going to discuss with you a question from June 2023 exam, Mar-Jun 2023, that is OXWICK company. So let's read the exhibits, what's inside it. The question says, OXWICK company is a listed company, fruit flavored soft drinks manufacturer, for which has increased its profit significantly over the last few years. So it's a listed fruit flavored soft drinks manufacturer. It has increased its profit significantly over the last few years and is looking to expand. OXWICK's directors have identified Ludham company as a potential target. Ludham is an unlisted family-owned company. It produces a premium brand of soft drinks, the Ludorchard brand. OXWICK's directors are aware that the Ludorchard brand is stocked in a number of retail outlets where OXWICK's company's drinks are not stocked. So OXWICK is a listed fruit flavored soft drinks manufacturer. It has increased its profit significantly over the last few years, is looking to expand. OXWICK's directors have identified Ludham as a potential target. They want to acquire Ludham. Ludham, unlisted family-owned company. It produces a premium brand of soft drink, Ludorchard. OXWICK's directors are aware that the Ludorchard brand is stocked in a number of retail outlets where OXWICK drinks are not stocked. So it's a good brand. That's why it's stocked in a number of outlets, and OXWICK's drinks are not stocked there. That means Ludorchard is a good drink than them. Assuming Ludham is acquired, OXWICK directors believe that OXWICK will be able to spend more on marketing the Ludorchard brand than Ludham has been able to spend, increasing sales significantly. So OXWICK's directors think that if we acquire Ludham, we can market this Ludorchard brand more than Ludham company. Obviously, Ludham owns Ludorchard, but maybe Ludham doesn't have enough cash or resources. So OXWICK thinks that if we acquire them, we may be able to spend more than them on marketing, which will increase sales. It will also achieve other synergies which will increase value and justify the acquisition. However, one of OXWICK's non-executive directors believes that the acquisition will be of no value to OXWICK because it does not reduce risk. He feels that OXWICK shareholders want the company to make acquisition which reduce risk and therefore increase company value. He believes OXWICK should consider acquiring companies with different product streams or one or more of its suppliers. So the summary of this exhibit is OXWICK is a listed company. It manufactures soft drinks. It wants expansion, so I've identified Ludham as potential acquisition target. Ludham manufactures Ludorchard brand, and it's a good brand. Ludham, if acquired, OXWICK believes that it will be able to spend more than Ludham on marketing, so it will increase sales, will increase other synergies as well. But one of NED says we are buying a soft drink brand. This is not reducing risk, so we should go into other product streams. Okay. Exhibit 2. Exhibit 2 has some financial data. Okay. Ludham's profits have remained static during the past 3 years. Ludham, the one which I'm acquiring, its profits have remained static during the past 3 years. That is an unlisted company. There is no information available about forecast cash flows. You don't have any information about forecast cash flow. OXWICK has 200 million shares in issue. Current market price share is 11.52. Its most recent post-tax earnings, that PAT, is 128 million. Ludham has 80 million shares. Its most recent post-tax earnings were 52 million. Assume that Ludham's current valuation can be obtained by using OXWICK's PE ratio reduced by 40% to reflect Ludham's unlisted status. Very easy. You should assume Ludham's valuation can be obtained by using OXWICK's PE ratio. Okay. And reduce it by 40% because it is unlisted. The post-tax cash flows for the first year of the combined company are estimated to be 270 million. These are expected to increase by the following percentage each year as a result of volume increases, synergies, and inflation. So post-tax cash flows will increase by 12% year 2, 10% year 3, 7% year 4. Tax allowable depreciation is assumed to be equivalent to the amount of investment needed to maintain existing operations. TAD is equal to working capital. Additional investment in assets, including working capital, will be required of 28 million at the end of year 1. In years 2 to 4, additional investment in assets at the end of each year will be 0.8 for every dollar when increase in post-tax cash flows. After 4 years, the annual growth rate of free cash flows will be 5% for the foreseeable future. It will be assumed there will be no additional capital investment from year 5 onwards. Okay. Combined cost of capital is estimated to be 12%. Combined companies debt to equity level will be 2080 market value terms after acquisition has taken place. Directors of OXWICK assume that shareholders of Ludam will require a 15% premium on fair value of their shares to satisfy their own shareholders. OXWICK directors believe acquisition should result in a minimum gain to shareholders of at least 15%. Ludam want 15% premium, and OXWICK directors believe their shareholders would also want a gain of at least 15%. Okay, that's it. Let's see what the requirements are. Discuss the non-executive directors' views in relation to OXWICK's acquisition strategy and acquisition of Ludam. So we have a view of non-executive director here. One of non-executive directors believes acquisition will be no value because it does not reduce risk. He feels that shareholders want the company to make acquisition which reduces risk, therefore increase company value. He believes OXWICK should therefore consider acquiring companies with different product streams. And it is of the opinion that if you acquire this Ludam, you are going in the same brand of soft drinks. This is not reducing risk. We should go in other product streams, or maybe buy one of our suppliers, because supplier will be manufacturing our raw material, so our risk will reduce. Okay, so discuss the NED's views in relation to acquisition. Okay, so you just have to comment on NED's views. Just discussing what do you think about his views. So I will write the NED is of the opinion that if OXWICK company is acquiring Ludam company, it's manufacturing same thing as OXWICK, that is soft drink. So risk is not getting reduced as we are going in same business stream. He thinks that OXWICK should go in other product streams. Okay, this is the view. Okay, so I need to discuss. Discuss means tell about pros and cons. In short, the NED wants diversification. Okay, now let's just discuss. So his view is welcomed. Obviously, everybody has a right to share the view, but let's discuss his views because that's a requirement. Discuss the NED's views. Okay, that's the main thing. Pros and cons. Okay, so in my opinion, he's saying that it is not reducing risk because that's why it has no value. I think personally that this opinion seems wrong. Shareholders don't want reduced risk. They want it a bit, but they are mainly interested in maximizing shareholder value. If acquisition of Ludam is increasing shareholder value, shareholder wealth, no matter it is not reducing risk, it will still be acceptable to shareholders because they want their wealth maximization. Similarly, there is one more point that when you go into other streams, You don't have experience of managing those streams. So maybe because of less experience, they won't be that good for you. So in my opinion, a company should keep a balance of risk and return rather than just focusing on investments which reduce risk. Okay. Other views are also welcome. Okay. It is not necessary that you are writing the same thing as mine. So while his views are welcomed and respected, but thinking that acquisition will add no value because it is not reducing risk is wrong. Shareholders want wealth maximization rather than only reduced risk. If this acquisition increases their wealth, no matter no matter with an increased risk, it will still be acceptable for them. Similarly, the NED's views recommend entering into different streams. The company may not sufficient expertise in managing new streams, but Ludham acquisition relates to soft drinks brand, which we have experience of. So this will also be a plus point. Overall, the acquisition should keep a balance between risk and return rather than solely focusing on the risk reduction. You can also write this regarding acquisition of supplier, that if we acquire a supplier, we get a bit protected because of supply lines. But for that, we don't need acquisition. We may make contract with 3 or 4 suppliers to ensure competitive advantage rather than buying or spending too much. This can also be written. Okay, so you can copy, then we will move forward. If you want to make it more lengthier, you can add that supplier point as well, which I just stated. Okay. Now, estimate using data available the equity value of the combination of OXWICK and Lodam. So you need to find the equity value of the combined company. Okay, equity value of the combined company, that is the requirement. Okay, so I will find the equity value of combined company. It's in Exhibit 2. The post-tax cash flows for combined company 270 million in the first year, rising by 12 cents, 7 TAD equivalent to this working capital, additional investment in assets. So it seems I should find this equity value of the combined company by FCF method, but FCF to the company or FCF to equity, I am given WACC. So I will apply FCF to company. Okay. So I am now starting value of combined company through FCF to company or FCF to firm method. How did I know? Because I am given post-tax cash flows, which are increasing. Okay, because it has only asked, it hasn't mentioned the method. Okay, that equity value of the combined company, combination of OXWICK and Lodam means combined company, which method I should follow. So for combined company, it mentions post-tax cash flows first year 270, then increasing, then TAD, working capital, additional investment in assets, growth rate of FCF. So it's quite obvious that we need to find equity value of the combined company through FCF method. FCF to equity or company, WACC is given, so FCF to company. Okay. So as I have told you before, first make format of FCF to company method. Sales. Cash cost. TAD gives operating profit. Interest. PBT. Tax. Now, since this post-tax figure is given, okay, I didn't have the row in my format, this row. I didn't had in my format, but since the question has given post-tax figures, I have to create the row because had operating profit been given, I would have deducted interest to get PBT, then tax. So if PBT had been given, I would have written tax, but it has given post-tax figures. I have to start from here. Add back TAD less investment in working capital, investment in NCA, FCF company. So discount factor, WACC, present value. Okay. Then total present value of all future FCF is the value of company. You deduct value of debt, you get value of equity, and this is the requirement that equity value of combination of OXWICK and Lodam. So equity value of combination combined company FCF to firm method. I have told you how did I reach FCF to firm, because post-tax cash flows were given for 4 years, then free cash flow would grow by this was written, TAD working capital was given, investment in NCA was given. It's quite obvious FCF to company method because WACC is also given. Okay, so let's start. 4-year data is given. So let's make it 1, 2, 3, 4, 5, 2. infinity. Okay. So what is the figure given? Post-tax cash flows of the first year, 270 million. You are not given sales. You are not given operating profit. You are not given profit before tax. Had sales been given 270 here, operating profit percentage been given here, PBT given here, post-tax figures given, that means after-tax figure is given 270 in first year. And how much is rising by 12, 10, 7%. So multiply by 12%. %, and 7%. Okay, this is the post-tax cash flows. Then it states TAD is assumed to be same as working capital. So write both as same, add 1, deduct 1. So 20 add 20 less, 10 add 10 less, everything is the same. So 0 add 0 less would also be the same thing. Right? 10 add minus 10, net off. 5, then less 5. 10, then less 10, same thing. Okay. Investment in NCA. What about investment in NCA? It states 28 million year one and 0.8 for every $1 increase in revenue. So 28 in year one. And 0.8 for every $1 increase. 0.8 for every $1 increase. So difference of C10 minus B10, increase in revenue times 0.8, but it will be negative. Then negative difference of D10 minus C10 into 0.8. Then negative E10 minus D10 to 0.8. Okay, so 18.6, 24.2, 25.92, and 28. Okay, so this is also negative. You get FCF2 company. Okay, so 242, 276.5, 308.5, and 337.3. Okay, now this is the FCF company for the 4 years. Now it states after 4 years, the growth rate of FCF is 5% for the foreseeable future. It is assumed there will be no additional capital investment from year 5 onwards. Now, don't do it like this. That you do like this, that after 4 years, it's 5% for the foreseeable future, right? 5%. So you do like this, that E13, sorry, E14, the FCF, then 5%. This was the traditional practice, it's correct. But the problem is, if you take this figure, this includes this investment in NC as well, right? If you take this figure, 337, and then increase by 5% the FCF figure, this includes capital investment in NCA. You have already deducted it. But it says there will not be any additional investment from year 5 onwards. So to incorporate this point, what you have to do is because this E14 FCF, which we have done traditionally, it includes capital investment. Okay. So we don't have to include capital investment because in future it won't come. So we will take this E10 figure, the 355 figure, because this is without the adjustment of capital investment. Okay. Now discount factor is WACC. What is WACC? 12%. So 12% is WACC, 0.893, 0.797 from the table, 0.712, 0.636, and last discount factor, that's E15 upon WACC 0.12 minus G 0.05. Multiply to get present value, B14, steric B15. Okay. B14, steric B15. Okay. Okay. This is the total present value. And then add it to get total present value of all future FCF, sum of B16 to F16, 4266.19. Okay. Value of debt. So it's 20% debt, B17 into debt to equity ratio of the combined company is 2080. So you deduct it and you get value of equity as B17 plus B18, that is 80%. Okay, 3412.895. Okay, so we have got this requirement that equity value of the combination of OXWICK and Lodha, it's this in front of you, 3412.5. You can copy this. Okay. Okay, so after doing this, the requirement was the equity value of combined company. So I did with free cash flow method and got the equity value of the combined company as 3412.895. We have just done the workings above. Now it states percentage gain in value, which would be gained by OXWICK shareholders. It is only asking for percentage gain in value, which would be gained by OXWICK shareholders. Okay, not the other shareholders, only the gain which would be earned by OXWICK shareholders, including whether it will fulfill the expected shareholder requirement of 15% gain. Now, where is this part coming from? It's mentioning that the directors of OXWICK, it's mentioning that the directors of OXWICK assume shareholders of Ludham require 15% premium on their fair value shares. To satisfy their own shareholders, OXWICK's directors believe acquisition should result in a minimum gain to shareholders of 15%. Okay, there's the requirement. Equity value of combined company, we have done that, and percentage gain that would be earned by OXWICK shareholders, concluding whether it is fulfilling 15% gain in shareholder or not. How do we check how much gain OXWICK shareholders are gaining? This is the equity value of the combined company. We will deduct equity value of the separate OXWICK. And we will deduct equity value of Ludham company to get additional equity value, also called gain from acquisition. Okay. Okay, so to get how much gain one group of companies getting, the acquiring, OXWICK is the acquirer. So it's asking gain OXWICK shareholder will get, the acquiring shareholder will get. So to get this gain, we take equity value of combined company, deduct OXWICK and Ludham to get additional equity value and gain from acquisition. Okay, let's look at the financial data to get equity value of OXWICK. OXWICK has 200 million shares in issue. Market price per share is 11.52. Okay, so share price is 11.5 to 200 million shares. You will get equity value of OXWICK. Okay. Equity value of Ludham. Ludham has 800 million shares in issue. Its most recent path was 52. Assume Ludham's current valuation can be obtained by OXWICK's PE ratio reduced by 40% to reflect Ludham's status. So Ludham's valuation of current valuation can be obtained by OXWICK's PE ratio, reduce it by 40% to take its unlisted status. Okay. So Ludham's valuation will be obtained using OXWICK's PE ratio. So let's find OXWICK's PE ratio. OXWICK's market price per share is this 11.52 over earning per share is 128 over 200. Okay, so let's get it. 11.52 is the market price per share or earnings per share. OXWICK PE. So OXWICK's market price per share is 11.52 divided by OXWICK's EPS. So it has 128 million profit and divided by the number of shares are 200. This is OXWICK's PE ratio. Ludham PE, it states reduce it by 40% to take it unlisted status, so reduce by 40%. Okay, Ludham's value through PE ratio method. So according to PE ratio method, the formula of value is Market price per share is equals to PE ratio into PAT. So PE ratio is 10.8 into PAT is 52 million. 561.6 is its value. Deduct that to get additional equity value or gain. 548. This is the additional equity value created. Now, if we get this additional equity value by acquisition, 547.295, is this whole gain for the acquiring company, OXWICK? Usually, is obviously OXWICK is acquiring. So combined value less individual levels, this gain is for OXWICK. But from this gain, OXWICK has to pay premium of 15% to Ludham shareholders. So Ludham shareholders will want a 15% premium above their equity value. So their equity value is 561.6. So they will want 15% premium above this. We have to pay this to them. Out of this gain. So net gain only for OXWICK shareholders, it's 547.295 minus 84.24. Okay, this is gain for OXWICK shareholders, right? So what is the percentage gain? OXWICK shareholders gained 463 million, that is D11, and their original value was 2304, D4. So in percentage gain terms, they gained how much? 20%. Okay. Since they expected 15% gain, but they are getting 20%. So we can write the percentage gain in value, which would be gained by OXWICK shareholders, 20%. Whether it will fulfill the expected shareholder requirement of 15% gain, since they expected 15%, but they are getting 20%, this gain is fulfilling shareholder requirement. Okay. That ends this part B. You can copy and then we will move forward. So is that how much gain one group of shareholders getting from acquisition? Combined value less individual values gain less the premium paid, that's their gain. Okay. Okay, now let's move to the last requirement, discuss the assumptions made in calculations in part B. Very easy and mark scoring requirement, assumptions made in calculations in part B. Okay. Now, assumptions in part B. So let's talk about this. So Ludum's profits have remained static during the past 3 years. There is no information about cash flows. OXWICK has 200 million shares in issue. Current market price per share is 11.52. Most recent PAT is 1.28. Ludum's has 80 million shares in issue. PAT was 52. Assume that Ludum's current valuation can be obtained using OXWICK's P ratio reduced by 40%. Okay. So you have to discuss assumptions. It has been assumed that Ludum's valuation can be obtained by OXWICK PE and reducing it by 40%. It didn't ask you to state the assumptions, it asked you to discuss the assumptions. Okay. So you need to discuss on what grounds this 40% is found needs to be addressed, as 40% reduction seems to be a bit big just because of unlisted status. You can write that it is usual to reduce it by 20-30%, but 40% is a big number. Okay. And secondly, any more assumptions? You are assuming the cash flows are increasing by 12, 10, 7%. On what grounds this is being done? This needs to be said. TAD is assumed to be equivalent of working capital. It is assumed that TAD is equal to working capital. So on what grounds this has been made also needs to be considered. You need to discuss them as well. Just didn't write. This needs to be written when it states state the assumption. That as discuss the assumptions, you should add or less some points. Additional investment assets will be required of 28 million. Additional investment will be pointed for development. After 4 years, annual growth rate of free cash flow is expected to be 5%. It is assumed there will be no additional capital investment from year 5 onwards. It is assumed that free cash flows will grow by 5% till perpetuity. The grounds for this also needs to be investigated. You can write it in points as well. it is assumed there will be no capital investment after 4 years. How the company will operate without investing in assets needs to be taken into account, because without investment, it is impossible to grow. Company's cost of capital is estimated at 12%. Okay, debt to equity ratio will be maintained at 20. This is also an assumption. Directors assume that shareholders will require a 15% premium. How do they know this? They require 15%. Maybe some require 15, maybe some require 20. This can also be written. So overall, this seems to be a very easy requirement. We have done this many times in the classes as well. Okay, you can copy this, add one or more assumptions, because 4 I've written, and that would be it. Okay.